Have you ever heard of the lost decade? The lost decade was a period of time where investors went 12 to 13 years without seeing any growth or any gains on their portfolio. We're going to talk about how to make sure that this does not happen to you, just in case history repeats itself. My name is Kyle Demian, and welcome to the Wealth Academy. Let's dive in. So this chart that I'm showing you now comes from our forecasting tool, our forecaster, that we use to help our clients with their retirement income planning. But for this conversation, we're actually just going to look at it from data and research. And the first thing I want you to see is that we're going to assume a starting balance of $500,000. And this chart down here is going to show it's going to show from the years 2000 all the way up to 2015 and the exact returns of the S&P 500 or the overall stock market. Okay, this is going to demonstrate the lost decade and what it would have looked like if you had $500,000 entering retirement. Now, psychologically, I can imagine that a lot of people probably wanted to retire when they were heading into 2000 just because it was a new millennium, right? And the 90s were fueled by a lot of great years and great growth in the market, especially when technology like the internet first came about. And as we are going to go through and look at the 2000 through 2002 phase, now looking back is actually referred to as the dot-com bubble and the dot-com bubble crash. Now, that coupled with the 2008 crash is going to lead us to what we're referring to as the lost decade, as I'll show you just here in a second. But imagine this, it's 1999 and you are going to retire. Fueled by the rising stock market of the 90s, you think that the stock market is going to continue going and continue booming because that's what it's done the last 10 years. Here's your wake-up call. In 2000, the market is down by 10%. In 2001, the market suffers another 13% loss. And then in 2002, the market goes down another 23%. So just 3 short years into retirement, 36 months later, which in reality it can be quite a long period of time, your $500,000 is down to $300,000. And one thing we haven't even talked about yet, which I'm going to come back to at the end of this video, is that you haven't taken any withdrawals or any distributions from this money. Now, if this money's sitting in a 401k or IRA, very likely that you probably took withdrawals from this account as well. But for the sake of this video, we're just going to talk about no withdrawals just yet. Now, from 2003 through 2007, you have 5 straight good years of growth, averaging about 10% per year. And as you can see, by the end of 2007, you almost reach your starting point. You're back at $499,000. However, what happened in 2008? A near 40% decline sent you back to about $300,000. 2009, you get a 20% return. 2010, a 12% return. 2011, a 0% return. 2012, a 13%. And then sometime between 2012 and 2013, as you can see here, you finally cross over the chasm and you get back above your $500,000 that you entered retirement with. The only downfall to that is we're in the year 2013, 2012. It's taken you 10 years just to grow and gain any money from that original $500,000 that you started your retirement with. Now, this is if you stay completely in the market, right? One way to avoid this would be to diversify. Put your money into something safe, right? They say buy low, sell high. In theory, that sounds like a great opportunity. In 2025, where we find ourselves today, buy low, sell high, especially if you're going to be retiring and no longer putting money into the market. A couple of things that you can consider, that you should consider. You can't buy low if you're retiring and not putting any money into the market. Also, if you hear the word sell high, well, this isn't financial advice. This is simply financial education. But as you've probably heard or seen at some point this year in the market, the stock market has been at all-time highs, right? So consider diversification, shifting some of your money from risk on to risk off, aka principally protecting your money so that you never lose a dollar again. That is possible. Now, also, to go back to the chart and looking at the math here, as I mentioned, this does not include any distributions. Matter of fact, the lost decade gets worse if you are taking out any money, right? This shows it taking 12 years to get back to break even. But what if you take out 4%, which is what's known as the safe withdrawal rate? Safe withdrawal rate, what does that mean? That just simply means the rate at which you can safely withdraw from your portfolio so as to not run out of money in retirement. How do you make your money last to the entirety of your lifetime? Well, we don't know how long you're going to live, but if we were to assume 25 to 30 years, you probably want to take out about 4% because that's what the math and the data shows that you should do. So if we come back to the math and look at the rule of 4%, the safe withdrawal rate, you can actually see that you never make it back up to your 500,000. You start at 500,000 and that's about the highest you ever get because your withdrawals on top of the losses from the market creates what we call a double drawdown. Not only is your portfolio losing value because of the market loss, but also because of the income, because now you're retired and you want to take assets and money from your retirement accounts. So this shows that one that did this approach and took this approach would get as low as potentially $180,000 in their assets, and you truly run the risk of running out of money in your retirement accounts. Option two, what else can you do to protect yourself and insulate yourself from this risk? You could consider something like a fixed index annuity to lock in the guaranteed income that you need for life. You've worked hard to retire to build up your assets. Give you something that's going to continue on your paycheck. While you were working, you counted on a paycheck from your employer, right? If your social security and or your pensions aren't enough to meet your expenses and your monthly needs in retirement, consider creating another monthly source of income to cover your expenses guaranteed. That is how all retirees stay happy throughout retirement, knowing that every day that they wake up, they have a paycheck coming in to match their expenses, much like you did when you were working. And especially if you worked and saved so hard to build up this nest egg, you built it up for retirement income. Analyze and look at a fixed index annuity to see if it would be right for you, because many times the withdrawal rates can be better than the 4% income that a safe withdrawal rate would allow you to take, and this will be guaranteed for the rest of your life, something that you don't ever have to worry about. And lastly, the third idea I have for you is to sit down and just have a conversation with somebody now that you're retiring. When you're in the phase of growing and accumulation, you could probably do a lot of it by yourself. Absolutely. Your 401k and just contributing into that, you probably have done a lot by yourself. Maybe you used a financial advisor to help. Maybe you didn't. I've seen people from all phases of life get to their destiny, get to their retirement goals in many different phases in different ways. However, when you're entering retirement, the slide down the mountain is much quicker, especially if you're faced with some early volatility. So I encourage you just to speak to somebody, have these conversations. And if you don't have anybody that you already trust, feel free to reach out to us at the Wealth Academy by clicking the link below, scheduling a time to talk. If you found this video helpful and you had a couple of takeaways, please leave your thoughts in the comments below and subscribe for future content like this. Thank you guys for watching.